Hey there, students! Welcome back to G Tutorials. Let's talk about something that's super important but often overlooked: debt. Specifically, how debt can impact your financial stability while you're working hard towards that degree. First up, let's discuss picture this. You've got high levels of debt and suddenly interest rates start climbing or the economy takes a hit. That debt can make you way more vulnerable to financial shocks. It's like being in a boat with a small hole. One big wave and you're taking in water fast. Debt servicing costs. It's a fancy term, but essentially it means paying back what you owe, plus interest. If times get tough and you're struggling to make those payments, it can lead to defaults, which is a nice way of saying you can't pay up, and that's bad news for you and the lenders. Another point: reduced financial flexibility. High debt means less wiggle room when unexpected expenses pop up, or if your income takes a hit. It's like being stuck in a financial straitjacket. Now let's talk about, if you can't meet your debt obligations, defaults happen. And defaults mean losses for lenders, like banks and financial institutions. It's a domino effect that can lead to more significant financial issues down the line. And don't forget about amplified shocks. When you're carrying a lot of debt, any economic shock can hit you harder and faster. Suddenly you're cutting back on spending more than someone with little or no debt, making the overall economic situation worse. Moving on to the high debt levels can lead to reduced consumer spending and investment. Less spending equals weaker aggregate demand, which in turn can slow down economic growth. Then there's the misallocation of credit. Excessive debt can mean money is channeled into less productive or riskier sectors, which isn't great for long-term growth. High debt can also put stress on the financial system. If defaults become widespread, banks and financial institutions face losses, potentially triggering a financial crisis. Plus, if the government's debt is sky high, it may have less capacity to provide fiscal support or counteract economic downturns. It's like trying to help someone up when you're already on shaky ground yourself. And finally, the increased risk of financial crises. When debt ratios soar, financial crises are not just more likely, they're also more severe. Let's look at some examples. High household debt means economies are more vulnerable to income shocks and interest rate spikes. This can lead to increased defaults and lender losses. Companies with high debt are more vulnerable during economic downturns, which can lead to bankruptcies and job losses. High levels of government debt can limit a government's ability to respond to crises, potentially leading to sovereign defaults and financial instability. So, there you have it. Debt can seriously undermine financial stability by making you more vulnerable to shocks, reducing your financial flexibility, and potentially leading to defaults and financial crises. Understanding this can help you make better financial decisions and navigate your way to a more secure future. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and share with your fellow students. Stay financially savvy.